Chapter 10 looked at the calculations for capital budgeting projects with the assumption that there were point estimates of what the values would be. So we knew what the sales would be, and we knew what cost would be, and so forth. Chapter 11 acknowledges that these are just estimates, and maybe what we need is sort of probability distributions of the possible outcomes. So it attempts to look at that spread of possibilities rather than one specific point estimate. In the first section, it just talks about, in general, what do we mean by projected flows versus actual flows. And one of the definitions pointed out is forecasting risk. Forecasting risk, the possibility that errors in projected cash flows will lead to incorrect decisions, also known as estimation risk. And by incorrect decisions, they mean you accept a project that you should have rejected or reject a project that you should have accepted. But mainly it's you accepted one you should have rejected. Section 11.2 gets into scenario and other what-if analyses. And they show base case, lower bound, and upper bound, and we'll talk about that extensively when we do a separate video on 11.2. Scenario analysis has best and worst case scenarios based on upper and lower bound values. We're changing several different variables at one time. The text notes that instead of best and worst, it might be more appropriate to use optimistic and pessimistic. And one thing that I noted here, they give an example for a gold company that deals in gold, and notice the base case is 1,000 per ounce, per troy ounce, and they also give a $1,200 case for troy ounce. Well, as I record this, the price is, I want to say, $1,675. So our upper bounds and our lower bounds may not end up being correct. Sensitivity analysis is another version, investigation of what happens to NPV when only one variable is changed. So unlike the scenario analysis, we're going to change only one variable. For example, we might just say leave price per unit, leave variable cost per unit, leave fixed costs all the same, and let's just see what happens with unit sales. And for you marketing students, that's particularly important because we're relying on unit sales when we try to decide whether to take on a project or not. So we want to know how sensitive our decision is, and namely what our NPV, how sensitive our NPV is, to changes in the unit sales value. Simulation analysis is done with computers, and I'm going to give an example of that in a separate little video. Then we get into break-even analysis, and they just talk about, well, what are variable costs and what are fixed costs? A marginal cost. Marginal cost is the change in cost that occurs when there's a small change in output. So we change output a little bit, how much will our costs change? Marginal revenue, same sort of thing, only it's on how much money comes in. And then we look at accounting break-even. And accounting break-even is the sales level that results in zero project net income. Remember, this is only about the project. It's that sales level that results in zero project net income. And then breaks that down and goes into another section on operating cash flow, sales volume, and break-even. And in this case, they sort of show the formula and turn around the formula until finally they get to a section where they talk about accounting break-even revisited and cash break-even. So remember, accounting break-even is at what point do we have a zero net income and quantity, and cash break-even says the sales level, the quantity, that results in a zero operating cash flow. So this was net income, and this one is on cash flow. And then financial break-even. And financial break-even says that sales level that results in a zero NPV. So we've got based on net income, based on cash flow, based on NPV. This summary of break-even, you'd want to understand that, but I'm going to go into detail on that material. In 11.5, they'd go into operating leverage and the degree of operating leverage. Operating leverage is the degree to which a firm or project relies on fixed costs. So the idea here is in your production, you might buy an expensive machine, and now you have high fixed costs, but that expensive machine is able to produce at a lower cost per unit, so you have lower variable costs. In that case, you would have relatively high operating leverage. The degree of operating leverage is the percentage change in operating cash flow relative to the percentage change in the quantity sold, and we'll go into that in a later video. And finally, we get into capital rationing, and capital rationing just means that that you don't have all the money in the world. You are limited on how much capital you have available. And this definition is the situation that exists if a firm has positive NPV projects but cannot find the necessary financing, so you don't have enough money. Soft rationing refers to a particular business unit may be assigned so much money so you can find projects, and here's how much money you have to invest. Hard rationing is when they just simply don't have access to any more capital. That's a maximum that the company has available. So that's just a brief overview, and now we'll get into greater detail in another video.